Hello and welcome. I'm your host for today of our Sustainability Watch webcast about total impact valuation. Uh, my name is Uwe Schulte, and I'm the head of the Global Sustainability Center of the Conference Board. Before we get started, I would like to point out a few logistical details about this webcast. First of all, and most importantly, we are keen to get your feedback and your questions. You see at the bottom left of your screen a box where you can share your questions, and I will be watching this carefully and make sure that we reply to your questions at the appropriate moment. You can download the presentations that we will be showing today. The slide deck, that's the next box on the bottom of your screen. You can download it and look at it in more detail because this might be a little bit small on your screen, but you can also click on the four arrows on the top right-hand side and trigger the full screen mode for the presentation. And if you click it again, then you are back to this view. This webcast will be recorded, and you can share it with your colleagues, and they are free to download it at least from next week onwards. You can also earn CPE credits with this webcast. You have to type your full name and email address in the space provided, and then during the webcast, 3 times there will be a pop-up message, and you have to click on it, and then for that you have to stay online for the entire webcast. This, for those people who watch this as a recording, is of course only valid for the live webcast. We would like to encourage you, as I said, to ask questions, and we would really love your feedback at the end of the webcast. It only will take you a minute to answer a few questions, and we would appreciate that as it helps us to improve our service for you. Now, let me start by introducing our panelists. Our first speaker will be Thomas Singer. He's the principal researcher in the US for sustainability. He has published a large number of publications in the field, and he's just released a report on total impact valuation. Hello, Thomas.
Hi, Uwe. Thank you for that introduction, and hello, everyone. Thanks for joining us today.
Okay. Next on our panel is Sonja Hout. She is the head of strategic measurement and materiality at Novartis. Sonja has worked on impact valuation at Novartis since October 2015. Previously, she served as the head of the group reporting systems development in Novartis Finance, launching and implementing reporting processes for the group function. She joined the pharma division in 2001 as team leader business warehouse. She earned an MBA from IMD, International Institute of Management, and holds a master degree in physics and mathematics from the University of Freiburg. Welcome, Sonja.
Thank you, Uwe, and hello, everyone.
Yeah, thank you for joining us. And last but not least, Gerd Kompelman. He is the global head of business advisory and reporting at ABN AMRO, and with more of 18 years of experience in the banking sector, he started as a private banker, investment advisor, and later on as the head of an investment team. The last 6 years, he has been working with ABN AMRO's corporate strategy and sustainability department. He heads up a team that offers advice on sustainability and is responsible for integrated thinking and reporting. Welcome, Chair.
Thank you. Hello, everybody.
So let's get started. You might be wondering what that is, the Global Sustainability Center. I will be very brief. We have researchers in the US, Europe, and Asia, and we are trying to support our member companies to create long-term value and positive impact through sustainability integration. We want to do this with timely, thought-provoking, and relevant research. We use the UN Sustainable Development Goals as our framework and are guided by responsible standards and frameworks for corporations. We try to be fact-based, and we pride ourselves to give independent advice. So much about the center, who is organizing the Sustainability Watch webcast series, which you can, of course, subscribe to the whole series if you're interested. So let me ask Thomas. Thomas, that report I've already mentioned, I understand it's the second part of you looking at impact valuation. Can you tell us more about it?
Yes, of course, Uwe, I'd be happy to. Just a little bit of background for everyone. So in late 2017 at the conference board, guided by our advisory board, we launched a research initiative to examine this practice of total impact valuation. And the way we think of total impact valuation is it's really an emerging practice in company reporting. Primarily, that focuses on quantifying and expressing in financial terms a company's economic, social, and environmental impacts. And ultimately, the goal is to convey the full extent of a company's impacts on society beyond those captured in traditional financial statements. Now, that's a lot to take in. It sounds like it's not exactly all that straightforward to think about. But this is what we decided to examine at the end of 2017, this emerging practice of total impact valuation. And I'll walk you through some findings from our most recent research in this area, phase 1, which we released last year, and phase 2, which we just released earlier this month. But before I do so, let me just give you a sense of what this means, total impact valuation. You see the description here on the slide, but what does this actually mean in practice? And I think one simple way to understand it is by looking at an example from a company that has been releasing impact valuation results. And this is from Argos, cement multinational from Colombia, Argos. And this is what they call their value-added statement. And what you can see is that they're essentially showing what their net value to society is relative to their retained benefit or profit. And the way that they've done this, and several companies do this a little bit differently, and they show these results differently, but the way that they've decided to do this is by, quantifying and putting a monetary figure on a number of their impacts, both positive as well as negative. So things such as, salaries and benefits, taxes, talent development, which includes, employee training, community investments, and then on the environmental side, greenhouse gas emissions, other air emissions, water consumption, etc. So the idea here is to get a fairly quick sense of where the company's impacts are across those three spheres, in the economic, social, and environmental, and to do so through a common language, right? In this case, the language of dollars or monetary figures. So I want to be clear that there are many different ways that companies involved in impact valuation are presenting their results, but this is just one way to give you a sense of what this looks like. And as Uwe said, we've been at the conference board, we've been involved in this research field for now a couple of years. And last year, we published the first phase results from this research initiative. And that phase was really intended to provide an overview of what this practice is all about. It examined, what companies are involved in total impact valuation. It examined what the primary approaches of those companies look like. So what kinds of methodologies are they using? Are there similarities or differences in those methodologies? How are they choosing to value some of these impacts? How are they determining the price of emissions, or the price that they should assign to water consumption, or even to fatalities, et cetera, right? So the goal here was to conduct almost like a literature review of this practice. What are the organizations involved here? How are they doing it? And what are some of those differences across the various approaches. So that was phase one, and that report has been published now for about a year, but we just now released the results from phase two earlier this month. And phase two is really a deeper dive into the actual way that companies are using impact valuation. So whereas phase one was kind of an outside-in view, phase two was all about understanding from the companies themselves, how are they going about impact valuation? Why did they get involved? For what purpose? And how are they using the results in their day-to-day business? Phase two of the research was conducted through a survey as well as interviews with 10 companies that are very active in impact valuation. How are they using this approach or these various approaches? Is impact valuation creating value for businesses? And if it is, how so? How are they going about it? What kinds of stakeholders are most interested in impact valuation? Where are they getting criticisms? And then importantly, what challenges have companies faced along the way? So you can see the logos of the 10 companies that were involved in this research phase. A few different sectors represented, some heavy representation from the materials and chemicals, but a few others are also in here. And most examples that we found in this case were from European companies, with the exception in this case of Argos. So that's enough of kind of the background and the research and what we did. The report is available on our website for any of you interested. But what I'd like to do is just briefly share with you a summary of what we found through these conversations, through these interviews with the companies that have been very active in this space. We call them trailblazers because there's not that many companies currently involved or actively and publicly involved in impact valuation. So they're very much at the front of this practice. Now, the first thing I'll share from these conversations is that pretty much all the companies we spoke with, 9 out of 10, believe that impact valuation creates value for them. The issue is that for many, the methodologies of this practice are still too new for impact valuation to really help steer strategy. This was a little bit surprising to us from the research team because we came into the research thinking, okay, impact valuation must be about strategy and helping companies steer strategy and inform their strategy. But in fact, that was really only the case for about 4 out of the 10 companies we spoke with. The remaining companies, the 6 or so companies really pointed to the fact that many of these methodologies are still too new to help them steer strategy or guide strategy. So it was only 2 out of the 10 companies are regularly using results from impact valuation to steer strategy. And that means using those results more than twice a year during internal strategy briefings. So that was fairly surprising to us. Now, related to that, all respondents agree that the biggest challenge right now of this practice is the lack of standardization. There's just too many different approaches. There's no real agreement as to how to value certain impacts. And there's just so much variety and variation in these approaches that it does make it difficult to again, inform strategy, to guide strategy, or to do any kind of real benchmarking or comparability analyses across companies. So that was the biggest challenge identified by companies. Now, I would say that most companies we spoke with would like to see a standardized approach. There's some kind of variation between those who think it should be standard across sectors or different approaches depending on company sectors. The majority would say that it should be kind of at a sector level. Standardization should be done at the sector level, but there is some kind of discussion still going on around that. But the biggest challenge is this lack of standardization, and there's a real desire to have some standards in this space. And there are initiatives aimed at that. For instance, the Value Balancing Alliance is one example of an initiative aimed to bring some level of standardization here. The third piece I'll point out to is that when we asked companies what the biggest benefit of this approach was, they pretty much all pointed to external recognition. You would think, going into the research, you would think perhaps informing strategy or understanding impacts, but because of what I've mentioned, because of the challenges of steering strategy, really at this point, the biggest benefit that companies are finding is that these approaches are giving them credibility and trust with stakeholders. Investors and even pension funds are also interested in companies that are involved in this space. They realize that not much benchmarking can be done at the current moment, but it is in some ways a proxy for how mature a sustainability strategy is, and it really It gives a sense that companies are thinking holistically about their unpriced externalities. Now, I talked a little bit about how these approaches for many companies are not really embedded in strategy, but that's not true for all. There are a couple of companies in the sample or in our interviews that actually have been very intentional about embedding impact valuation into the strategy function in their organizations. And when that is the case, they've actually been able to use the results from these types of analyses quite strategically. So they've been able to unlock business opportunities. That means, for instance, entering new markets. The results from these analyses have shown that they're creating this much societal value that they've been able to enter new markets using these results. Or they've also unlocked some risks, risks related to their externalities, whether that's greenhouse gas emissions or even costs associated with employee turnover, just to give you a couple of examples. So these approaches can be quite insightful when embedded into strategy. Now, lastly, and this is pretty interesting, I think, is that, well, one, every company we spoke with intends to continue to be involved in this practice. But more interesting than that to me is the fact that 7 out of the 10 companies we interviewed and spoke with believe that impact valuation will either be expected or even required of companies in the future. This, to me, signals the fact that we should continue to pay attention to this practice. No companies we spoke with think that this is a fad or likely to sort of disappear in the next year or two, that this is a short-term kind of initiative. They all believe this is here kind of for the long run. And in fact, as you can see here, some believe that this may even be required at some companies. So I think, to me, a signal to keep paying attention to this practice and that it perhaps could represent the future of non-financial reporting if some of the issues are taken care of. So I'll stop there because I know we have some really interesting things to hear from the other panelists today who are deeply involved in this practice.
Thank you so much, Thomas. This is quite an interesting report, and we seem to see an evolving practice here. And Sonja, I would like to ask you, as you have been featured in Thomas's report, how this actually came about at Novartis and what it means being a pharmaceutical company involving in that practice of total impact valuation. And I'll already mention that we have a question from the audience specifically to that industry sector, but let's first hear from you.
Thank you, Uwe, and thanks to Thomas for sharing his research highlights. Before guiding you through a number of thoughts and how impact valuation came about at Novartis, I'd like to share a brief video clip. Could we have the video, please?
Over the last 100 years, Novartis has been an innovating company. We have played a leading role in bending the curve of life. We reimagined medicines that treat malaria, keep hearts beating longer, help lungs breathe, and alter genetic diseases. What does this mean in today's complexity of huge societal challenges, fast-changing expectations, and quantum leaps in technological progress? Innovation must go beyond R&D. We need to innovate how we measure and manage our impact and respond to risks and opportunities. We approach this by using materiality assessments to help us understand how our stakeholders perceive our impact. It helps us prioritize issues to focus on and understand their interconnectivity and interdependencies. Materiality assessments serve as a tool to capture non-financial and often intangible issues. We work with partners to establish methodological concepts to measure and value our impact in monetary terms, helping us to include non-financial issues such as social and environmental impacts in our business and investment decisions. Too often, companies focus on optimizing the financial output of their operations rather than how to create or destroy value through business activities along the entire value chain. To create long-term value, we need to understand and manage our positive and negative economic, social, and environmental impact. Only by considering all of our impacts can we at Novartis truly succeed to improve and extend people's lives by reimagining medicine.
Thank you. Now, when we started into launching the financial, environmental, and social impact evaluation project back in 2015, really had a whole multitude of questions and objectives around understanding our impact more broadly and having finally a tool set that would inform strategy, decision making, but also unify some of the conversations about non-financial topics within the company. So these objectives, ideas about applications, readouts, and use cases are still valid today. We have achieved some of them, not all of them though. As per Thomas's research results, the practice is still emerging, yet already delivers powerful results that come with insights, that come with new questions as well, but certainly help to have a more robust dialogue internally and externally. So what I'd like to call out, though, first of all, is that here we use the term impact valuation in a very specific way. So this is to differentiate impacts from inputs and outputs that are more the traditional metrics of what it is that a company puts in to a certain effort, be it of their commercial practice or non-commercial practices, to really enter into the sphere of the so what and be able to actually quantify that and express, well, what has really changed due to that activity or the intervention. So here we use impact measured and we express their results in monetary values, in dollars in our case, to really have a way of getting a view on relative size and importance, linking back to our materiality assessment. Now, the materiality assessment was at the origin of our impact valuation journey to actually guide our thinking as to which areas to look at and look for indicators to actually dive deeper in and have a more holistic view on. In doing so, we felt we grouped those indicators in 3 areas: in financial, environmental, and social impact valuation results. You can see the indicators there. In the financial space, we really felt that starting off with, say, profits really doesn't do the trick. I mean, profits is an internal measure and certainly interesting for some of the stakeholders, but the contribution to wealth and employment overall and to every country is certainly a lot more interesting. So we turned that into an economic measure. In the environmental space, we look at climate change, CO2 equivalents, almost all sorts of air pollution and topics like water and waste. And here the interesting thing is, I believe, for a company at our position in the value chain is that we do this for our own operations, but also our entire supply chain. In the social impact valuation sphere, we started off with the elements that were there and we could actually use from existing practices that were impact valuations around employee development and occupational safety. But actually the heart of the matter for a company like ours is, of course, to understand the social impact of our products. A link to that and supporting initiatives are health system strengthening interventions that come in a variety of facets and forms. Now, an interesting one that I'd like to call out here, and that was around the topic of fair pay in own operations and in the supply chain. So looking at the jobs created in the economic analysis, we were curious to understand more whether these jobs are good jobs or where we have actually hotspots or exposures to pockets of unfair pay. So that is what was delivered through the social impact of living wage analysis. Now, since 2015, this has evolved, been scaled up and is actually now available in an internal system for all of our countries of operations. And we do have actually data for more than countries we have a presence in. The 2018 results are actually available for 188 countries. The scope of indicators varies, so it's not everywhere the full set of scope, but we're working towards that. What you see here is a glimpse on how we interact with the countries on their results. So we do use something that you saw in Thomas' introductory slide on a value bridge or on a net societal value to just spur the discussion and get a view for how results resonate with the leadership teams, but also to actually have one visual that actually brings all the results together. Normally, these conversations are very rich. They come with highlighting surprises, highlighting questions on data, on methodology, but always really furthering and deepening the understanding of everything related, and pretty much circle around the purpose of our company. It was mentioned in Thomas's research as well that it's a fledgling approach, was the wording on his slide, and there are methodological gaps or question marks. So there's one thing to observe those, but then we felt we shouldn't be stopping there and contribute to actually closing those, or actually try and engage in a conversation with experts, with broader audiences on these. So in that spirit, there were a number of case studies published, also referenced in our annual report suite, that hopefully contribute to actually having a better and easier way for other companies in the future to actually join the group of practitioners of impact valuation.
Thank you so much, Sonia. That's absolutely great, but I have to already raise a question that came from the audience. And the question was, in the sector of healthcare and hospitals, would you be able to talk about best practice or sustainability successes, or a real reduction of greenhouse gas or positive social impact? Is there something you could mention there?
There are a number of initiatives. Actually, the most exciting one is just in the work in progress. So I don't know whether it will actually show those positive results that are referenced. But I hope that by the end of the year we can actually see to that and show those results. In the meantime, an interesting thing to me was an initiative launched by our environmental colleagues, our carbon sink project. So in Colombia, Argentina, China, and Mali, we run forestry projects actually originally intended to act as carbon sequestration initiatives. Then looking at it through the lens of impact valuation, though, we discovered that the social impact related to these around job creation, providing livelihoods, are sometimes also significant, and in one instance even stronger than the originally intended environmental impact. So yeah, there are things like that around the topic of CO2 and hospitalization. I have to admit that that's a further shot at the moment. There are, though, redesigns of clinical trial setups, for example, where in order to make it easier for patients and for doctors to participate and join in, we aim for a more decentral setup, and that decentral setup, of course, also comes with a reduction of CO2 emissions related to the reduced commute from and to the research centers.
Thank you, Sonia. There's a couple of other questions here. One is you have on one of your slides the word "I am portfolio." The question is, what does that stand for?
IM is actually the abbreviation of one of our divisions. It's innovative medicine. So this is where pharmaceuticals and oncology are summarized, and the other division is Sondo. So currently we look at the IM portfolio of products only. It's already quite some a bulk of work to go through.
Thank you. Yeah. The other question is not directly related to our subject, and I wonder whether we should enter it in any detail, but as it's been raised, I would like to put it to you. Can you comment on the current opioid crisis, especially in the US?
Yeah, Uwe. I saw this question popping up. It's something that I wonder whether these types of crises could be prevented by a clearer view on upsides and downsides of products. And then I'm wondering whether these crisis elements were in the intended use of products or whether they're elements of things being used differently. So I can't really knowledgeably comment on the situation in the US from an impact valuation point of view at this stage.
Thank you, and I perfectly understand. I hope for our audience that is acceptable, but if there is more interest around that, we can of course engage in another event around that. Now let's get to you, Jed. For me, it's relatively clear how a company that deals with physical goods and especially healthcare is conducting impact valuation. When it reaches the financial sector, this is a little bit different. Can you enlighten us?
I can definitely try, and I agree that it is challenging to say the least. And I also agree with what has just been said by Sonja and Thomas, that I think for all sectors, including the financial sector, this is still, we're still exploring this area. So this is new, and there will be challenges when everything, with everything that's new. The same goes for impact reporting. And for the financial sector or for a bank like us, we have some additional challenges because we actually finance companies, for instance, I'm not sure we do, but for instance, like Novartis. So to assess our own impact, we need to assess the impact that we have through financing all these clients, both corporate and retail. But we tried nonetheless, and this is one of the reasons why we try, because we try to measure our long-term value creation in order to manage it. And it has been said a few times before, can we actually steer on this? And working in a bank with other bankers, for us it's crucial that we measure it and that we monetize it as soon as possible in a sensible way, with the ambition to steer on it. So that is where we are, and I'll show you how we got there. We have integrated sustainability into the core of our strategy and purpose. So this is the integrated strategy for the group. Purpose is banking for better for generations to come, and our strategy is called Accelerating the Sustainability Shift. And this is not a separate strategy. This is the overall group strategy. And the question then comes: can we also related to the strategy? Can we measure that? And how can we measure it? And how can we steer on it? And then it's very, very early on we come to the discussion or the topic of impact and how to measure our impacts. And what we did this year, for the first time actually, is to publish a separate impact report. It wasn't our goal, when we started it wasn't our goal to publish a separate report. The idea was just, can we find a way to measure our impact? and can we develop a framework? Can we work together with other partners, with other banks, with other institutions to develop this field for the financial sector? But we felt that the journey was so valuable and the insights were so valuable that we said we need to publish this in a separate report as part of our total external disclosures. I mentioned this before, but I keep mentioning it also within the bank. The idea, the ultimate goal is to steer on value creation for all stakeholders. That is what we are trying to do. And in order to do that, we first need to measure and then we need to report. Report can also be an internal report, but ideally it would be external. And the goal is always to steer on value creation for all stakeholders. We started this journey a long time ago. I don't think this sheet is very easy to read, but it's just to give you an idea that even back in 2012, we did our first experiments with what we called integrated profit and loss. We did some smaller pilots with smaller parts of our business, but it was mostly quantitative. So it was mostly a quantitative analysis of where we felt different impacts were. But it did give us the confidence and the experience to build on and to explore the monetization of all our impacts. And this is actually the journey that we shared internally as well. So coming from integrated thinking, integrated reporting, building on the concept of long-term value creation, and Sonja mentioned materiality or material topics. The term materiality was kind of confusing within a bank and with various stakeholders. They had various different ideas, so we like to call them value creating topics. And building on those value creating topics, we moved towards monetization of our impacts. And that the result of all that work is published in the impact report. The discussion around frameworks, I totally recognize that debate. We use a multitude of frameworks, starting with the integrated reporting framework, but also frameworks from Natural Capital Coalition. And for the impact statements, we use a framework with these 4 steps, where we first assess the value for stakeholders, then the value for investors. We also try and show and be completely transparent on the negative impacts, and we try and link as much as we can to the Sustainable Development Goals to give it some more substance. So how do we measure and report, or what is the first 2 phases of the 3-step program? And here you see on the left side the capitals coming from integrated reporting, so the 6 capital model, and on the right you see the 4 stakeholder groups that we have identified and that we report against or have been reporting for a number of years now. So we know these 4 stakeholder groups quite well. And we try and combine the impact per stakeholder or the value created per stakeholder. This is monetized and netted impact. And I'm quite against netting impact, so that's why I like the next picture more. It's maybe a little bit harder to see, but the gray circles here are negative impacts. And on the left you see the 6 capitals, and on the top the 4 stakeholder groups. And each circle represents a certain number. So we tried not to be too specific, because that would give, in my view, a false impression of where we are in these measurements. But all circles give a certain indication of the value and the impact created. We use these insights to further develop the total value creation model of ABN AMRO, and the value creation model is obviously the baseline or the base for our integrated report. And it's difficult to see probably here, but you see on the thickness of the lines we also use to indicate a difference in impact, on impact per capita.
Jed, sorry for interrupting you. We have a question concrete to a slide before. Jyoti asked, shouldn't do not harm be on the top of your list?
It could be. It's definitely part of the list, but it is, if you want to create impact, it's both. It's do no harm and it's create more positive. If you only focus on the do no harm, let's use a natural capital as an example. If you only focus on reducing, let's say, CO2 footprint in our lending activities, then we probably forget to focus on building on a renewable energy portfolio. So we need to do both, but I definitely agree that we need to be transparent on the do no harm or on the negative impacts that we have as a company and that any company has. So it's good to be transparent and not to net out these impacts too soon. So great question. Thanks for that. This is definitely not readable, but it just shows the level of detail that we try to give in the impact report per stakeholder group, per capital, and also linking it to the contribution to the SDGs. And on the relating to the question, the do no harm, be very transparent on where we believe we have a negative impact and what means we have to reduce those negative impacts. So the next steps, I think you can guess them already, and I know Sonja and Thomas have mentioned them also, but for us the next step is to steer, and we are not there yet, and we are mainly busy doing the report again for next year or for 2019, but also talking to a lot of stakeholders and other companies to invite them to do the same, because that is what I truly believe that this work needs. It needs more than 10 or 20 or 30 companies working on it. We need hundreds of companies. We need more banks, more insurance companies, more asset managers to give a serious attempt on impact reporting, so that after that we can debate which methodology works best or how we can improve certain methodologies. So we would really like to steer on value creation and on impact. I don't believe we're doing it consistently at the moment, but it does provide us with very valuable insights, both on positive and negative impacts, and it gives us an opportunity to steer in future. I have some contact details in the slides. If you would like to know more, please feel free to reach out. In the meantime, have a look at this impact report. And send me over any other impact reports that you feel are worth reading, because I think we can learn most from each other in this area. Thank you very much.
Thank you so much, Jed. That makes it a lot clearer. We have another question here, which I am going to read in a second because I was briefly out. Based on your integrated profit and loss chart, it appears that your largest negative impact is finance impact on clients. Can you talk a little bit more about that? And it seems that it is at least your core business, isn't it?
Yeah. It's good to say that this is a P&L, so a profit and loss, and the profit and loss has inputs and outputs, and the negative input from the financial perspective is that clients pay us money. That is a negative financial impact for them. So from their perspective, from their P&L perspective, it's negative impact. That's how you should read that gray one on financial. And just to pick on the other one as well, positive and negative impacts. Do negative impacts outweigh the positive? Thankfully not. In total, we create a positive impact. But again, here, it's important not to net them out, because then you lose a lot of value from the exercise. So you need to show both be transparent on both ends, and try and reduce where you have negative impact and improve where you have the positive.
Okay, thank you. We've been asked to provide the links to the reports that Thomas has mentioned. We will do this in the discussion box, but we will also, of course, give you the opportunity in the slides. There was a question before about, I must say, I have to plead ignorance on that one from Jyoti on the China study on plant-based lifestyle impact. Sonja, are you aware of something like that, or maybe we have to ask Jyoti to explain better?
It sounds quite a specific question. I'm from a Novartis perspective. There have been releases of reports on China, but so among which one on the forestry projects that are also run in China, and an overall an overall Novartis in Society report that has come just out this year, actually.
Yeah, I think I suggest to Jyoti get in contact with us, be a little bit more specific.
Yes, please.
What your question is, and we will endeavor to answer that question. I apologize that we are not able to do this right now. Let me continue the conversation for both of you, Sonja and Jed. You've talked about how you got there and how you engaged. And one of the problems, it seems to be, is the standardization. And let me just try to explain to the audience this with a concrete example. So most of those total impact evaluation reports look at, of course, greenhouse gas emissions and what they do. Now, because it's monetization, it's not looking at tons of CO2, but it looks at the value of those tons of CO2. And there already is a discrepancy because people might be using different values of costs of CO2, which of course can have a large effect on the results. How do you see that?
Yeah, good observation, Uwe. Indeed, those valuation factors are important and drivers of the results. However, the strong point of impact valuation is that it invites that deeper conversation about what might the underlying tonnage really be and what the volumes of water used really are. As Gerd said, you shouldn't net too quickly, and the same goes, of course, for all the underlying detail. I mean, impact valuation gives a great overview of the total positive and negative in our case, financial, environmental, and social impacts, but by no means does it stop there. Let me make that as one statement. The other statement that is quite relevant for us as a pharmaceutical is that all those damage cost-based shadow prices, irrespective of where they end, establish a link between environmental degradation and human health. And this is a very powerful link and a very strong element, though, for us to go after that. Do the discrepancies allow for easy comparison? No, they don't. And it's something that we're actually also working on together with the Value Balancing Alliance. And hopefully, over time, there will be a convergence, if not standardization, of approaches and also data points.
Thank you so much.
Could I add to that? It took us a long time to standardize financial reporting. It's taken us a long time to standardize more or less sustainability reporting. It will take us a long time to standardize impact reporting. But that is okay. As long as we are open and transparent, we can agree to disagree on what, just the easiest one is the carbon price. There's numerous ways of accounting for carbon and saying we need to charge $10 or 10 euros per ton or 100 euros per ton. If you explain to the reader or to the stakeholder which metric you used and why you used the metric, then that is similar to the way that you apply accounting principles on financials. And accounting principles are still being developed today. I've lost count on which IFRS standard we are nowadays, but we are developing them continuously. And the same will be the case for impact reporting. So that is okay, and it is good to know and to be aware of it, but not to hold anyone back on starting this journey.
Thank you. That's very clear. There's a specific question for you as well, Jed. This is around you saying you want to go for steering. The question is, are you going to put in red lines in terms of investment and, for example, stopping fossil fuel excavation activities, financing them?
Well, if you know where your biggest impacts are, and this could be very well be one of them, then the question will become, how do you mitigate these negative impacts? And mitigating by stopping a certain activity, the question would be if that is truly mitigating or just offloading it to someone else. So we try and have an inclusive approach where it comes to mitigation, and to see if we can support our clients in their transition to becoming less negative, more positive, having a better total net impact. Obviously, there is a red line. There is one today, and there will be one tomorrow, and the red line will move in the years to come. But the goal of impact reporting is not to exclude certain activities. It is to be aware of where the impacts are, positive and negative, to see if we can find ways to mitigate it if it's negative, and in a bank's case or in an investment case, to see how we can improve situations.
Yeah, thank you. Thank you so much. Thomas, Sonia referred already to the Value Alliance. Is that a way forward to move towards more standardization?
I think it can be, as Chad alluded to actually very explicitly. This practice can only really move forward with a volume of quantities involved in it, not 10, not 20, not 30, hundreds, right? And I think initiatives such as the Value Balancing Alliance and the Impact Valuation Roundtable and other similar roundtables and kind of gatherings of organizations working in this space and trying to figure out impact valuation is the way forward to encourage learnings in this space and to help others who are maybe interested in impact valuation but don't know how to move forward with this practice to get their feet wet in it and start to learn how to move forward and eventually come to some sort of convergence, if not standardization.
Sonia, can you tell us a little bit about that initiative of bringing more companies together?
Yeah, happy to. It starts with attempting to lower the hurdles of adoption. So clearly, for the first-time user or the not yet user, the question is with methodology to follow when it all seems very confusing, starting from the visual outputs from the available described methodologies. But in the heart of the matter, very much as Geert said, there's not so much contradiction. Things are very alike. So the question for the Value Balancing Alliance is, can we say in a short period of time possibly show how that could look like, and just have a conversation distill from there and evolve, so that over time we get to a set of completion that may resemble the standard like we have it outside the sustainability space with US GAAP or IFRS. So here with standardization comes also a commoditization, so that it's easier to source these methods and easier to implement them, rather than going through an individual tailor-made approach whereby you need to basically figure it out for yourself. instead, I hope the output will be that we can actually encourage others to start off with a predefined set of indicators, with a predefined set of values. Of course, not to stop there, but to help and contribute to the discussion should they be not happy with what they see, or should they feel that their business models are not adequately reflected.
Thank you. Very, very clear. And it looks to me that a number of very key players have come together, not only those who apply it, but also consultancies who have provided methodology there. So as Gerd said, it won't be a short process, it will be a long process, but it seems to be going in the right direction. As almost a closing, I would like to ask each of you, when you look at your experience and your journey, what was an unexpected outcome when you started applying this methodology, and what did really surprise you? And can you share that with us? And I would ask Thomas to speak for those who aren't represented today here.
Yeah, I think based on the conversations we've had with 10 plus companies in the space, one of the big surprises is the extent of the positive impacts that sometimes don't go accounted for. And we're talking about some of the social impacts, whether it's wages, whether it's employee training and development. So many of these impacts that we know what the investments are in those areas, but we don't actually know what the impacts are until we sort of go through these types of approaches. And I think many of those have been revealed or have come to light through some of these approaches through impact valuation.
Thank you. Sonja, anything that was unexpected for you when you went through the process?
Actually, a number of things were really, and all positive. So I think overall, the largest topic is that this conversation about impacts and their valuation seems to really connect the dots with a lot of narrative, with a lot of threads, with a lot of conversations, and seems to help bring people together around a joint view on the issue at hand or on the activity at hand. And this is such a powerful element that I just wonder why there are not more companies adopting that practice. It's just so rewarding and so insightful. Of course, at the back of that, there are a number of smaller insights, surprises about which element of impact is maybe less negative than feared, others are more positive, but sometimes things are also more negative than hoped for or less positive than expected. So all of that around the results, of course, is always ongoing. But the biggest element which really makes me believe that we're onto something that is there to stay and that is there to actually contribute at a larger scale is the fact that it has the power to bring together so many different stakeholders, so many different functions internally around the same conversation.
Thank you so much, Sonja. Gerd, any unexpected elements you would like to mention?
Yeah, we had the same experience, I think, as Sonja. We had dozens of unexpected findings. One of them being that you need a lot of data. You need a lot of data to make these calculations, much more data than I had expected. And that there are a lot larger impacts, both positive and negative, but mainly positive, that we were unaware of, or that we didn't have a sense of how much the impact, the one that Thomas mentioned, just on employee training, that is a very internal calculation, but it is a big impact. So there were some surprises there as well. And there were also surprises that at board level, where you see that we are looking at this in a different way, making these impacts far more concrete. It changes the narrative within a company if you monetize certain impacts. It changes them from, okay, so possibly we have a negative impact in this value chain, to the negative impact of our activity there and there is 200 million. That is very helpful in these narratives.
Thank you so much. I would like to thank the panel for giving us something that the conference board always strives to provide, insights for what's ahead. I think we can clearly say that for all companies, something around total impact is ahead for all of us, and it is good to get involved and understand and help shaping this space. So thank you for the panel, and I would like to point out in our series Sustainability Watch, the next webcast in 4 weeks on the 17th of October will be ESG disclosure and integrated reporting. And before we go, I would remind you that a webcast evaluation will come up now, and please spend a couple of minutes to answer these questions. It will help us to improve our service. Thank you to the audience for your lively participation, and thank you again to the panel. Goodbye until next time.